Okay, now we've got to get to the bottom of this because there is, and I'm sure you go to your family gatherings, you go to Thanksgiving, you go to Christmas, you go to these places where other people and you start to, money starts to come up as conversation, and maybe there's debt, like maybe there's a talk of like borrowing money, and then there's people that gasp. Like if you were like, hey, like how much debt, like I guess it's not like you're walking around telling people like how much debt you have or how much debt they have, but I mean
Have
like,
you ever seen me at a birthday party or family gathering, John?
but
I'm always talking about it.
you are,
Yeah.
you are. So, but I think there's like this, maybe that's the reason, is that people are afraid to say how much debt they have, and it brings up the debate that we kind of want to talk about here today, which is like almost want to make a case for you to say, especially if you're thinking about trying to pay off some debt that you have. Maybe it's in your business, maybe it's in your, you know, personal life, and you've used it to buy an asset, and you're kind of like, I gotta pay that down. We're gonna
Mm.
try to make an argument here to say maybe stop that. Like
Mm.
maybe don't think about necessarily paying down that debt right now. So in this episode, we're gonna talk about good debt versus bad debt, and how to think about that. Kyle, this came up from an email you received from a person that you had met, and to talk about their financial goals, that they're
Mhm.
thinking about their financial journey. You're helping them kind of navigate that, and they were like, I want to make sure I pay this debt off before I do anything else. And you're like,
Yeah.
wait a minute, we got to talk about that. So give us the
Yeah.
details on this person.
Yeah, I'm gonna set the context a little bit here. So this is an incorporated business owner, has an operating company, runs a successful business, and I'm gonna say like they're after paying himself his income via salary, dividends, so on, has retained earnings of typically between 100 and $200,000 per year in the company.
Okay.
And so far, this particular individual has been kind of, we'll call it like shove. I like to say it's like taking the retained earnings and shoving it under the corporate mattress. It's like
Right.
hiding it under the corporate mattress, keeping it as retained earnings, which we're huge fans of, but not just throwing it into a savings account. Or in this particular case, this individual has put it into GICs. GICs have high interest rates, at least, going into this recording. They are starting to come down. We had the first rate cut recently by the Bank of Canada. Looks like the Fed's going to be following in the fall. But the reality is, even at those high interest rates, the part that this particular business owner didn't recognize was these GICs are being taxed at the investment income rate of about 50%. That's that passive income
Right.
tax rate inside the corporation. So, when I shared that, they're like, oh, that's not as good as I thought it was going to be, right? 5% becomes 2.5, 6% becomes 3, whatever. The real issue was like, what do we do instead? So we started talking about strategies. We started talking about how permanent life insurance inside of a corporate structure is massively helpful to take the tax target off of those retained earnings. Because no matter what you do with retained earnings inside an operating company, whether you send it up to your holding company, whatever you want to do, you can reinvest it into investments. The problem is if it's investment income, then you're going to be taxed at the passive rate. That's not fun. Or you will get a capital gain, right? So I can put it into a appreciating asset, real estate. I can put it into stocks. I can do all kinds of things, and we will eventually realize a capital gain. There's nothing you can do about a capital gain, whether you do it inside the company, whether you come outside the company. New rules make it maybe slightly better to do it personally, but not if you have to get taxed personally in order to get it out. So that part's not an issue. But here's the deal. If you take that money and then you reinvest it into something that is going to appreciate or grow, you'll pay the capital gain tax. That's fine. That's fair, right? And it's not bad. We talk on different episodes about capital gains taxes. It's not as high as, say, your income tax you might be paying personally. But the reality is those retained earnings are still going to have to be taxed at the personal level by a shareholder, either this individual or a future shareholder once he moves on. So that's where permanent life insurance comes in, because the the tax benefits of it, not only on its growth, because you're not going to pay the passive income tax on the growth,
Right.
GIC like returns,
Mm-hmm.
but without the taxes, but then also the amount of flexibility they have. So we're working on a strategy for a number of weeks, right? So we've been on many calls, we're working out different strategies. And then the big issue was that the whole idea of building a policy and building this, sort of approach is going to rest on the idea of leveraging
Mm-hmm.
against the policy. And that leverage thing was becoming a really tough thing for this individual to sort of grapple with. So, like, picture
What?
the old Kyle, like
Yeah.
I struggled with interest with leverage when I first began, right? I was paying down my home and I was doing
Right.
all of these things until I sort of had this epiphany through some of the research and reading I was doing about good debt and bad debt.
Well, what was like the words? Like tell me about the words this person was using when you're talking about leveraging the policy. Like what were they afraid of? Like what were they worried about? Like tell me the thoughts,
Yeah.
because I'm sure you, like you said, you've had these thoughts. I'm sure I've had these thoughts, the person listening right now had these thoughts. So tell me specifically what was coming up in those conversations that was like the holdback here.
Yeah. This particular individual used words such as beliefs, morals, even mentioned,
Ooh.
came up, like this idea of like,
Like
not,
I
I don't think it was like morals, like you're a bad person if you
Right.
have debt, but it was
But I
like sort of
believe
like,
that like
exactly.
I
The,
that is just not something that I'm okay with.
Well, and it's like, and you can tell, I think belief's probably the better word of what he was trying to describe is like, as a family, right? So like in the past, we've been taught that debt is bad, and we try to pay off debt, and
Yep.
then so it's very Dave Ramsey-esque, right? So Dave Ramsey would be a huge advocate for paying down all debt. So he doesn't classify debt
Right.
as good or bad, or actually I should say it's all bad
All
for
bad.
him. But the reality is, though, is that is, again, you're never going to hurt yourself by doing that, but it is definitely a much longer road to try to build any sort of wealth and any sort of investment in financial freedom when you're doing it in that way, unless you have a substantial income that would allow you to be paying off debt while potentially doing some investment, or to be able to pay off debt, in a short enough period of time
Right.
that you can then begin investing and sort of have a long enough runway in order for those investments to grow.
Yeah. So the first, let's start making the case for, helping this individual, you know, come around to say like
Mm-hmm.
leveraging your policy is a better move here for you to take advantage because of the tax implications that are on his plate right now. So, like we've talked a lot in this podcast about leveraging your policy to go buy assets, right? It's like let's go buy an asset that has to be an almost like you can't just go buy almost like any asset. You have to realize that you are going to incur debt when you have that policy loan or any sort of debt, right? Like if I borrow this money from my family, I have to then maybe there's an amount of interest that I have to pay. It's like, okay, I borrowed it for a reason. Maybe it was to invest in my business, but the point there was to earn money on that.
Right.
The amount that you were going to earn, the accumulation of this asset was going to get bigger in a quicker way than the
Mm-hmm.
interest you're paying over here. So what like this arbitrage that we all use to try to grow our wealth by saying, I'm going to borrow money to make money. And the difference there, I'm going to be okay with. And because I'm going to go buy an asset that accumulates or appreciates, or I'm going to earn interest on this investment over here. And that's going to pay off the interest and put money in my pocket. That's the one of the ideas. And I think when people think about, okay, like I have to wrap my head around that because either I'm going to pay the interest or I'm going to lose out on the interest if I don't borrow. Like if I have no debt,
Right.
then I'm like, okay, so I have no debt, but I also maybe have no asset, but I also have like, okay, I might have this pot of money sitting right here but I'm losing on this, like maybe I'm losing on the ability to gain on
Mm.
say that asset or that interest. Like there's always we said this before, there's always interest somewhere, whether you're
Right.
paying the interest or
Yeah.
whether you're losing on the ability to earn interest or earn investment return. So like I think most people get if like this is like almost like litmus test number one. It's like if you can get by this idea that there's this arbitrage between the two rates that you're going to borrow and earn, some
Mhm.
for some people that's enough to move forward, and a lot of people that's enough to move forward. Like, okay, that makes sense. There's risk on the table here because you have this
Sure.
debt and you're trying to like, oh, okay, this can't be too
Yeah.
risky, but then
The
there's that
what
whole
if, the what if.
for
Yeah.
sure. So it's like when you have the right risk tolerance, then that makes sense. Then for a lot of people, that's the move. But some people are still not convinced on that, right? Like
Right.
that's not the only. But then this is the argument that you're trying to make to this individual is like that's not the only thing to consider here. And I think a lot of people think it is the only thing. So
Right.
what's another thing here that we should be
Yeah.
like
So,
factoring in?
the tough part is even once so I think on a rational front, there's a lot more to consider here. And we've had this discussion, but still takes time, even if you start to see all of the rational reasons, all of the logic as to why it makes sense. You still have to convince the elephant, as we've talked about, right? So from the book Switch, like you have got
Right.
this emotional side of your brain that you have to control or you have to try to tame because belief really is tied to emotion, right? So it's like I don't feel good when I kind of go against what I believe to be, the way things should be, even if, I've been proven maybe time and time again as to what I should really be doing here. The tough part for this individual, like, first of all, they weren't necessarily struggling with the leveraging against the policy because I think they saw, at least at this time, I'm guessing that would become an issue later for them as they actually went to leverage. They would probably have a bit of an emotional challenge there. So that's another hurdle that I think will come for them if they chose to go this path. But the reality is their bigger issue was they know they have some personal debt that they used in order to fund the business. Now, that personal debt was at I think it was like 4.5% interest in a high interest rate environment. Now, when they go to renew in a year or two, that rate may go up a little bit, and that might be scary at its core. But here's the challenge for this individual. They have just short of the amount they need to pay off that debt inside the company. It was about 600,000 or so. I think it's actually more than that in the company. That's in GICs right now, being taxed, half of the money going to tax. And then outside, they had something like $800,000 on this debt. And that is a scary number, right? So that
Mm-hmm.
debt is against this business, right? So, but he's personally holding it. The challenge is in his mind is like, I want to get the money from in the company, out of the company, so I could pay off that debt. Now, if that
Sure.
money was in his bank account, I could see how people would be like, listen, I'm just going to pay this thing off, or at least pay 3/4 of it off in one chunk. Great. I
Okay.
feel better, whatever. But here's the challenge. He takes that 600 out of the corporation. He's going to be gifting, 40 to 54%, depending how he does it, right? If he does a
Right.
dividend or whether he does a salary, he's going to do a dividend, of course, if he took it out in one chunk. And he's going to take that money out, lose all of that money to tax in order to pay off debt that's at 4.5% in I'm going to say, I don't care what CPI is right now. The actual inflation rate is definitely around that number, 4.5, maybe even more, because we know that the government likes to be very selective, right, in terms of the numbers or the products they put in that basket of goods that they're using to measure inflation. They keep changing it over time. So the reality is he's in this big pickle because he's like, in order to get over this belief, he wants to gift basically half of the money that's in there in order to get it out to pay off, less than half of this debt, just because, again, it's what we should, or what my belief sort of tells me I should be doing. So right there, fundamentally, that's a real challenge. Now, the other part, though, is that there's some other things going on in the background here that we have to recognize. It's one thing to, let's say, do arbitrage on a rate of return
Sure.
for an asset, like you said, but there's actually some other things going on. Like, imagine instead, if inside that corporation, let's say he gets that policy funded over the next few years, he's still got retained earnings that every year is going to contribute to the amount of money that has to be taxed on the way out, unless it hits a permanent policy so that it can come out through the CDA later. And there's leverageability so that he could then build more assets inside the corporation. So that's a really good thing here. And that's kind of the strategy we were working on. But there's more to it because, of course, we want the assets to grow greater than the amount that you're borrowing on this policy loan. But the reality is that there is an opportunity here for us to get a great rate of return by reinvesting those dollars. But then there's also this idea of the deductibility on the interest that he's borrowing. So on a personal side, he is actually able to deduct the 4.5% interest, just like the Smith maneuver, right? Just like that same idea, we can deduct that because that loan that he has personally is in order to earn money, in order to earn a return on this business. So that 4.5%, depending on the tax bracket, if it's 30 or 35% in, whatever the tax bracket is that he's pulling out right now, he's actually getting like a 30 to 35 or 50% discount on the 4.5%. Like that is substantial, right? He might be paying less than 3% in, after tax dollars. If we think about the return or the deductibility of that interest, and basically, again, he's got to take money out, pay tax in order to pay off this really low, really great interest rate instead of reinvesting into other assets inside the corporation to grow his net worth.
I just imagine it's like, okay, so I'm going to take money out of my business. I'm going to get taxed at that, which is going to drop its value. And then I'm going to take that and I'm going to pay off this debt, which actually will give me more taxable income to pay the government, when it's time to like claim my taxes.
You're compounding your tax issue, basically, is what it is.
Totally. And it was like almost as like, okay, I'm gonna put this down here, but all you did was just raise this taxable income on your side. So you have to figure out, okay, like you don't have to figure out, you just have to know, be like, it's going to like increase how much tax I pay personally by doing this. So I'm going to lose half there and increase my personal tax by just paying this debt off because I don't like the idea of debt. Right. And if money is an issue, then this isn't really probably the episode you want to listen to. It's like, if you need cash and you need to like get rid of this debt, that's a different thing. But we're trying to make the argument that you should keep it around because you're actually better off. Probably even if you do need cash to, think about some of these moves that when you make that move, there's implications. And you brought up this great point about tax deductible interest on your personal side. Now, there's another thing that I want to kind of bring up here as a piece around paying your debt off that I think lots of people miss out on or forget about. And if you think about it, like if you think, let's talk inflation, because I think you brought it up before too. Is like, let's talk inflation for a sec. So let's say you have $1 in your pocket right now. You pull out that loonie and it's like, okay, next year that loonie, right? That loonie, it can buy less because of inflation. Right. So it's like, but let's say compared to the year before, that loonie is now like $1.03 or something. It's like it's gone up by inflation or whatever that inflation rate is, 3%, 2%. It's like compared to the year before, you need more of those to buy this next one. But here's the thing. All of the goods and services rise by inflation. This is like how they track it, right? This is where the CPI really comes from. It's like that basket of goods you talked about. Every year, this basket is increasing, and we're like, we have to adjust, our purchasing power. Do you know what doesn't rise every year?
Your debt.
Your debt. Like the amount on the books doesn't rise if you're paying off your interest. And let's just say I'm not paying down the debt at all. Like it's just staying there. And let's say I put my money towards the interest every year, and it's like $100,000 or it's $10,000. It's like next year it's still $10,000. Next year after that it's still $10,000. 25 years later it's still $10,000 if I just paid the interest over that time. But all my dollar every year has gone in its essence. The purchasing power has like and it feels like it's
Decreased.
gone decreased.
It's like the
But
loony shrinking. If you imagine, it's like
right,
clipping off like three
the
or four
loony's
percent of it.
shrinking, but the debt is staying the same. And therefore, when you think back to the debt later in your life and you look at that number compared to your current value, like current value of that dollar in that time frame, you're like, that doesn't seem like a lot of money anymore.
Right.
So
I love.
it's kind of like when you hear about your parents going to the movies and they're like, or maybe it's like maybe you went to the movies and it was
Mhm.
25 cents. You're like, that's ridiculous to
Yeah,
go to
he's
the
like, I
movies for
worked all
25
day to
cents.
get that 25 cents to
Or
take your mother to the movie.
my father purchased his home, the home that we grew up in. He still owns this home for $40,000 in the 80s. And it's like when you think about that, it's like, okay, the debt he brought on was $40,000 in the
Mhm.
80s. And if you're like, is that like to him back then, that's a lot because it was compared to your purchasing power at the time, which is always what the case is. But in a long enough time horizon, the debt feels less and less every year just because
Right.
inflation's going up every
E-
year.
And I love, like, I want people to pause for a second. Like you were talking about, okay, there is a cost, like interest is a cost. And you can almost look at interest as
It's
being
why
like, well,
interest
wait a
is part
second.
of why interest is in there, right?
Yeah, like the
Part.
time cost of money, right? So it's like there's two things happening. It's like it costs you money because of inflation. That's why when high inflation environments happen, interest rates go up, right? So they try to make it harder to borrow money.
Right.
And that would allow people to stop buying, and then inflation will eventually come down. Like that's exactly what's happening right now. But the average person, we don't understand that. Plus, it's very emotionally hard to like wrap your head around, even if you rationally understand. Like I rationally understand how this works, and I still have my own emotional
Right.
challenges, right? With debt. Like when I get more debt, I still have this like feel, because that's where, what we've been, sort of raised to believe. But I really want to take this idea of inflation for a second. I want to like think about this for a second
Hmm.
and talk about what's really happening. So, on average, again, averages kind of mean nothing in the short term, but they mean everything in the long term. Okay. Because right now, inflation, even though CPI is saying we're in the 3% range, most people would agree we're probably still higher because things seem to continue to rise at a higher rate than 3-ish%. On average, over the last 62 years, this is from, we'll post the link in the show notes, but it says that in Canada, the average rate of inflation was about 3.8%. And that means that $100 in 1960 was the same as $986, or almost $1,000 in the beginning of 2023. So when you think about that for a second,
Hmm.
that is like the the value of a dollar basically tenthed. So it's like a loonie back
Right.
then, is like a dime now, right? When we
Right.
think about this and you go like, this is hard to really think about. It's like having a time machine, and it's really hard to kind of like think of it. It's hard to even think like, 6 months from now, let alone like over a long period of time. But here's an interesting quote. The Federal Reserve Bank of St. Louis, there's an article, we'll post it in the show notes, and they state, I quote, inflation transfers wealth from creditors to borrowers for all sorts of nominal debt, not just government debt. So it's, to
Mm.
me, it says two things. I mean, the obvious thing here is that when you borrow, you are getting wealthier, assuming when they say for all sorts of nominal debt, we're talking about good debt. We're talking about assets. When you aren't borrowing to go on vacation, and you're not borrowing to buy a car at a really
Right.
high interest rate, like these depreciating, items, the
Yeah.
expenses,
Sure.
essentially. We're talking about assets here. So when you think of all of the wealthy people in the world, and you think about, so often people say, well, how come so and so Trump doesn't pay tax? How come Elon Musk doesn't pay tax? How come all of these billionaires don't pay tax? Well, it's because they use debt, and they continue to get richer and richer. Now, they're not just using debt just for lifestyle. They are doing that too, but their lifestyle expenses are such a nominal, like such a minimal amount compared to their overall asset purchases, right? So
Right.
Elon Musk borrowed against his Tesla stock in order to buy what's it called now? I
Twitter,
don't even know. Twitter,
X.
which is now X, right? So like this is how people do it. Now, you have to have a head on your shoulders to know you need cash flow in order to maintain those debts. So we're not saying everybody go get indebted and
Right.
because you will lose assets if you can't maintain payments. But you need to be looking at these things and starting to figure out like what is the arbitrage that I can do here in a way that I can emotionally handle, right? And this is going to be different for everyone. There's no perfect formula here that you're going to have to figure out, but at least overcoming this idea of debt being always bad to wait a second, imagine a world. So like Jon, you and I, when we buy a property, we just bought a property in Arizona. We
Mm-hmm.
buy that property and we put down, and this property we put up very little to down. We'll talk about it on another episode. But when you put a small amount, even if it's 20% or 30% down, and you take on the rest as debt, when you think about that debt continues to grind away from inflation. And assuming it's an asset that does provide appreciation and or cash flow, you have somebody or somebody else paying down that debt on your behalf. So you have actually a double compound machine in the positive sense on this debt. The debt is worth less,
Mm-hmm.
meaning it's easier to pay off later. And you also have the asset itself generating some sort of income, cash flow, whatever, so that you can use it to actually start stomping out the actual debt. Now, I'm going to encourage you to reinvest some of the equity that you get out of there, but you don't have to reinvest every dollar. The key is we need to be able to overcome, we have to understand first how good debt works
Mm-hmm.
and how we can use it to our benefit. You can also really hurt yourself with debt, as I'm sure many people know, if you overdo things.
For
So
sure.
I'm thinking the big takeaway for me on this episode, I'm hoping people can at least begin the journey to think about debt differently. Don't do
Mm-hmm.
anything dramatic. Don't just like flip a switch and go, I'm all in on debt, but thinking about how can you use debt as a tool to help you get to your financial freedom goals, and how can you maybe overdo it and hurt yourself with it, and then
Mm-hmm.
decide where do you fit, at least in a short term, and maybe that might change over a longer term, right? So
Yeah.
just getting yourself
I like
open
it.
to it can really impact and change your trajectory.
Yeah. My big takeaway on that last one for sure is like tomorrow's dollar actually pays off more of your debt next year than what it would pay off today because of
Mm,
inflation, right? So it's like that's an important idea that we never consider. Like there are 3 points that we brought up here that kind of help you wrap your mind around why, answering that question Kyle just prompted about where you stand on debt. That first one was thinking about the asset accumulation, thinking about, how do we leverage this value so that we can make money on, say, the arbitrage between the amount that we're paying in interest and the amount that we have potential return on an investment. The second piece was thinking about your tax deductions that you may be getting because of the debt. You have to want to factor that in when you're considering, borrowing to invest or buy that asset. It does play a role in, the possibly the amount of return you're calculating because you're actually, you're saving on, say, the tax, the tax amount that you are going to have to pay to the government. The third one here was inflation and that fiat currency, inflation over time. That debt will, the dollar amount doesn't change, but since inflation is going up, the amount that debt feels to you because of the dollars you have in your pocket, say 25 years later, that debt is going to feel much different to you 25 years from now than it does today. And that's a strong consideration when you're thinking about that debt over time. I think we often forget about that. Folks, this was another episode of the Canadian Wealth Secrets podcast. If this is the first time you listened to an episode, we encourage you to hit the subscribe button. We put these episodes out every Wednesday. We also put out secret sauce episodes, shorter ones, every Friday. Hit that subscribe or follow button so you get notified of those episodes as they come out. Also, if you have listened before then we encourage you to hit that rate and review button. Let us know your thoughts. What was your big takeaway? Hit that button, write a quick rating review. It helps other people build and figure out what their financial journey is going to look like, and they're going to learn secret sauces along the way. All right, folks, that's it for us, and we'll see you next time. Just as a reminder, the content you heard here today is for informational purposes only. You should not construe any such information or other material you heard here today as legal, tax, investment, financial, or other advice. Jon is a mortgage agent with Bricks Mortgage, license number M23006803. Kyle Pearce is a licensed life and accident and sickness insurance agent and VP of Corporate Wealth Management with the Pancourt team, including corporate advisors and Pan Financial.